Welcome back, everyone. Ready for another deep dive. The materials you've given us this time are incredible.
I know, right? It's amazing how much ground we're going to cover.
Seriously, we've got a little bit of everything: classic accounting textbooks, guides to financial management, even some real-world examples with companies like Costco and Walmart. Oh, and did I mention the Arabic texts on financial analysis?
Yeah, those caught my eye too. This is going to be fascinating, seeing how it all connects.
That's the plan. Our mission, should we choose to accept it, is to break down these complex concepts into those aha moments that make you feel like a financial whiz.
I'm in. Let's do it.
Perfect. So why don't we start with something fundamental to, well, pretty much everything in the financial world, the balance sheet equation. Assets equals liabilities plus owner's equity. It's like the cornerstone of accounting, wouldn't you say?
Absolutely. It's the bedrock. Everything a company owns, everything it owes, and what's left for the owners all have to balance out. Think of it like a scale.
Okay, that makes sense. To make it even clearer, one of the sources uses a simple example: buying office supplies. Let's say you spend, what, like $450 on supplies.
Right. So on your company's books, that $450 would increase your assets because you now own those supplies. But at the same time, it also increases your liabilities because you now owe that $450 to the supplier.
It's like a constant balancing act. And speaking of balancing acts, reconciling your check register, it's basically a mini version of this, right? Making sure your records match the bank's records.
Exactly. You're making sure every deposit, every withdrawal, even those pesky bank fees are accounted for. Just like in a company's books, everything needs to reconcile.
And speaking of a company's books, this general ledger example, wow, this is helpful. It shows how every little thing a company does, receiving cash, paying a bill, even the owner taking money out, how all of that affects this balance sheet equation we've been talking about.
It really highlights how dynamic things are. Every transaction leaves a mark, like a breadcrumb trail of the company's financial activities.
It's like putting together a financial puzzle piece by piece. But let's shift gears a bit and talk about something that's less about snapshots and more about the long game compounding.
Ah, yes. The magic of compounding. It's like that old saying, the best time to plant a tree was 20 years ago. The second best time is today.
Exactly. And it's amazing how even a small interest rate, like the 5% example from the Fundamentals of Financial Management excerpts, can really add up over time. You put in $100 and just let it sit.
Time is your best friend when it comes to compounding. That's what's so incredible.
Yeah.
The money you invest today isn't just earning interest. That interest is then earning interest and so on.
It's like a snowball effect. And this actually reminds me of the student loan example. It breaks down how your monthly payments chip away at both the principal and the interest, which can be an eye-opener for anyone trying to manage their debt.
Absolutely. Understanding even the basics of how those payments are allocated can make a huge difference. Do you have student loans by any chance?
Let's just say I understand the struggle. But moving on to something maybe a bit more exciting investing. What about this idea of the marginal investor and how they can actually move the market?
Right. Imagine the marginal investor as the one who's on the fence. They're not quite sure if they should buy or sell at the current price. Their decision, or indecision, reflects that point where the market price matches what they think the stock is worth.
But wouldn't the value that investors see be subjective? Different people will have different opinions on what a stock is truly worth, right?
That's what makes the market so exciting. Investor sentiment, news, global events, it all factors in. It's a constant dance between what the market says a stock is worth and what investors believe it's worth.
A very high-stakes dance at that. And speaking of risks, let's move on to bonds. We have this section on bond risk, specifically interest rate risk. You'd think a fixed interest rate would mean less risk, right?
Not always. Here's the thing. When interest rates overall go up, the value of existing bonds with those old lower rates tends to go down.
So it's like trying to sell something for $10 when everyone else is selling it for $8. You'll probably have to lower your price to compete, right?
Exactly. The source even uses this stark example, Allied bonds with a 10% coupon. Now imagine interest rates jump up to 15%. Those bonds would take a serious hit in value. It just goes to show that there's always some level of risk, even with what seem like the safest investments.
That's a really good point. Now, get ready, because we're about to talk about something that might seem a bit intimidating: the weighted average cost of capital, or WACC. But don't worry, we'll break it down.
Think of WACC as a company figuring out how much it costs them, on average, to get funding. It's a blend of their debt, preferred stock, common equity, the whole shebang.
Okay, that makes sense. So why should we care about a company's WACC? What makes it so important?
Well, imagine you're a company, right? You're thinking about investing in a new project. Your WACC is like a benchmark. If the return you expect from that project is less than your WACC, it's probably not a smart move. You need to clear that hurdle to make it worth your while.
So it's like a measuring stick to see if an investment is actually going to pay off in the long run.
Exactly. And to give you a real-world example, the excerpt uses Allied again. It breaks down how their mix of debt, preferred stock, and common equity all factor into their cost of capital. It's pretty cool to see it all come together.
Definitely.
Thank you for watching. Stay tuned for the next video in the series. See you soon. Abdallah Aldriny, Chief Financial Officer.